I want to discuss an option collar strategy. So let's consider the following hypothetical situation. Suppose you own 100 shares of a stock that is significant appreciation. So you're concerned about a drop in the stock price, at least in the short term, but you don't want to sell the stock. Perhaps you don't want to incur the tax consequences, or perhaps you're thinking that there's still some upside potential for the stock. How can you inexpensively protect this position? Well, a protective collar may be the appropriate strategy. To create the collar, you buy an out-of-the-money put and you write an out-of-the-money call with the same expiration date. So intuitively, the long put protects the downside loss. A put gives you the right to sell at the strike price. So if the strike price is 50 and the stock falls to a price of 35, you can still sell it at 50. So you make $15 there. Okay, or you keep from losing $15. The short call caps the possible profits. Okay, but it reduces the cost of the long put. What happens here is you are being paid for someone to have the right to buy the stock from you at the strike price. So if the strike price is 100 and the price goes up to 120, the person you sold it to can still buy it for 100. What do the payoff pictures look like? A long stock position looks like this. This is what you paid for it, and it goes up, and it has an arrow pointing up because there's really no limit to how high the stock's price could go. There is a limit to how low it could go. It can only go to zero, right? So it can go as high as possible, but it can only go to zero. Okay, but that can still be a pretty significant loss. What does a put payoff look like? A put payoff looks like this hockey stick here with the kink occurring at the exercise price or strike price. Remember, you have the right to sell at the strike price. So again, if the strike price is 50 and the stock is selling for 70, there's no reason to use the option to sell it for 50 when you could go in the marketplace and sell it for 70. So you just throw it away, and what happens? You lose the premium. That's this vertical distance here. The best that can happen if you're long a put is that the price goes to zero, right? In which case, you don't really even have to buy back the stock, right? You get to sell it. You get to sell it at 50, and there's no cost to buying it. If we combine the long put with the long stock, we get a payoff picture that looks like this. Your downside is now limited because the put option, remember, at the strike price, you can start selling at that price regardless of how low it goes. So it limits your losses. What this does is it looks like a call option. Still unlimited upside potential, but limited downside losses. If you happen to be short a call, the payoff looks like this. You receive a premium as given by this vertical distance here, and at the strike price, you have to sell. So for example, if the strike price is 100 and the price goes up to 110, if you don't own the stock, you'll have to pay 110 to buy it, and then you'll only receive 100 for selling it. So you get this payoff picture. If you combine the three together, you get a payoff that looks like this. Okay, limited downside, limited upside, okay, some upside participation, and what this looks like is it looks like a bull spread. A bull spread is a strategy you use when you're mildly bullish. You think the price will go up, but you don't think it's going to go through the roof. So it's a fairly inexpensive strategy. There are a lot of ways to create it, but one way is to buy a call option and then to sell another call option with a higher strike price. And that'll cap your losses, but you'll it won't be a very expensive strategy because you'll get back some money to from selling the call to pay for the call that you bought. What are the pros and cons of a protective collar? The pros are there's downside protection, there's still some upside participation, and it can be a low cost or net credit. By net credit, we mean you might sell the call option for more than you paid for the put. So the strategy doesn't cost you anything. You're actually even making a little money on the strategy. The cons are it caps your upside potential. You have to keep monitoring the situation, and it's going to be more expensive than simply being involved in a covered call. A covered call is a case where you don't buy the put, so you don't have that expense, but you're not going to have any downside protection. All right, you'll receive a premium for writing the call, but no downside protection. So, what are the collar formulas? Okay, it depends on whether it's a net debit or a net credit. The maximum profit is going to be in the case of a net debit, the call strike price minus the purchase price minus the net premium paid. The net credit version is the same call strike minus purchase price plus the net premium received. The maximum loss, the put strike minus the stock purchase price minus the net premium paid. Okay, same thing over here, except it's plus the net premium paid. The break even is going to be the stock purchase price plus the net premium paid. So here you're adding, here you are subtracting. And here the stock, for the net credit, the stock purchase price minus the net premium received. This is the case where this lowers the break-even point. So let's take a look at a real-world example. So I looked up the premiums for puts and calls for several of Microsoft's stocks. And here we have a March 410, a March 425, and a March 435. So the March 425 is roughly in the money. The 410 is out of the money for the put. The 435 is out of the money for the call. So what we want to do is we want to buy the 410 put for 1130 and write the 435 call at 1320 and receive 1320. So what's our cost going to be? Okay, the cost of the put minus what we receive from the call, 1130 minus 1320 turns out to be negative $1.90. The negative $1.90 means we have a net credit. Okay, you sold the call for more than you paid for the put. So if we use those formulas we had, the maximum loss is going to be the put strike 410 minus the cost of the stock, or the stock's price there. So minus 1260. The maximum profit is going to be 435 minus the stock's price, 424.50, plus $1.90, or 1240. And the break even is going to be 422.60. So if we were to graph this, it would look like this, right? And you can graph this by calculating or doing the payoff strategy for the long stock, the payoff for the long put, and the payoff for the short call, and then adding all those payoffs together, and this is what you get. You get this strategy that looks, as we said before, like a bull spread. Okay, so this is an inexpensive way to protect your position, and I hope you found this useful, and thanks for watching.